Hello and good day to Doctor and everyone. I'm Ilavalagi Madhuriviran, metric number 264435. In this video, I will explain about the Case 5, Caribbean Brewers, the transfer pricing, ethics and governance. The first question is, how can the majority shareholder shift wealth through accounting cost allocations and transfer pricing? The majority shareholder shifts wealth through accounting cost allocation and transfer pricing by influencing the decision on such factors. The majority shareholder in a corporation has various privileges when it comes to the decision making because the shareholders or the business is given complete control of the company. So it makes important decisions on the company's operations and investments. As a result, the majority shareholder would be in charge of processes such as transfer pricing and cost allocation. The other shareholders would simply take part in the voting process to approve or reject the decision made by the majority shareholders. In this case, Gara International owns 75% of Caribbean Brewers, and it is also the majority shareholder or parent of Caribbean Brewers. Caribbean Brewers being monitored both financially and operationally by the parent company, so the management are hindered with many economical and operational decisions. The next question is, how was the wealth shifting through accounting cost allocation and transfer pricing done in the case of Caribbean Brewers? The first is cost allocation. The allocation of variable and fixed cost is based on the percentage of sale. This causes the production of beer based on the sales growth. Second, the bottle shipping deposit was only charged for Trigua and not for Gara beer, contrary to the normal business practice where deposits at $8 per case of 24 will be collected from all returnable markets, but no deposit is collected on the export market for Gara beer, and as a result of that, the cost of the bottles pertaining to the Gara beer exports are expensed. Besides, the Gara International has made Caribbean Brewers responsible for production expenses as a percentage of sales, and it has taken away all the control of the production people towards the production of beer. Moreover, Gara International also refused to pay the shipping fees due to poor quality assumption. Jason Joseph, the production manager, feels that Gara International is only making false allegations about the quality to justify not paying for the shipments. Next is transfer pricing. The wealth was shifted by exporting the Gara beer to low tax regions. They tried to avoid taxes by selling Gara beer to the tax-free country of Bermuda, but actually they sell the beer directly from Antigua to the other Caribbean islands. The second is discount given to Gara beer sold to Gara Caribbean. Domestically, a case of 24 Gara beer sells for $50, but the exported Gara beer is invoiced to Gara Caribbean for $25 per case. The third is not including the bottle deposits for exported Gara beer. Caribbean Brewers collects a bottle deposit of $8 per case, but no deposit is invoiced to Gara Caribbean for exported Gara beer. Lastly, intercompany loan. The expansion of production facilities of Caribbean Brewers in 2008 was funded through a 10-year amortized loan from Gara International at a fixed interest rate of 10%. Okay, the next question is, who is armed by the wealth shifting discussed above? First is Caribbean Brewers, especially the 25% shareholders in Caribbean Brewers, the minority shareholders of Caribbean Brewers. Since Gara International became the majority shareholder of Caribbean Brewers, there have been no dividends were distributed to the shareholders. Also, the percentage of ownership for the minority shareholders or the existing shareholders were reduced. For example, JJ was previously had 25% ownership in Caribbean Brewers, which is now reduced to 8%. The second party harmed by the wealth shifting is the government of Antigua, which is losing out on tax revenues. Where all export sales of Guerra beer are made to Guerra Caribbean, a wholly owned subsidiary of Guerra International, which is located in Bermuda, a tax-free jurisdiction. According to Antigua Income Tax Act, the Caribbean Brewers is not necessarily vulnerable to tax reassessment, in large part because they are offsetting means of revenue to an intercompany account that has a lower tax rate than that of the tax rates associated with. The third party get affected by the wealth shifting is JJ, the production manager, and the other production personnel, because of their bonus were eliminated. It is provided that they are eligible for bonus if the total production cost does not exceed 43% of sales. The next question is, as an advisor to the CFO of Caribbean Brewers, to whom are you responsible? The first person is Chief Financial Officer. As an advisor, he should validate all the forecasts and budgets along with the financial reporting before the CFO's review, before releasing it to the parent company and partial owner's view. The second party is Board of Directors and Shareholders. Since Chief Financial Officer is responsible to the Board of Directors and Shareholders, so the advisor to the Chief Financial Officer is also responsible towards the Board of Directors and Shareholders. The advisor should present the financial planning and the budgeting as well as the financial problems to the Board of Directors. The last question is, what are the implications of the composition of the board members to the reporting of the Chief Financial Officer? The board may begin to acknowledge tax issues on the exports of Guerra beer. It may affect the composition of the board because there is potential penalty for tax avoidance. The cost of exports being charged to Caribbean Brewers affects overall profit of Caribbean Brewers. And also in the composition of the board, there is duality role where the Chief Executive Officer and Chairman of the Board of Caribbean Brewers are the same person. This can create conflict of interest and can cover any fraudulent activity. The implication of the composition of the board members reporting to CFO is mainly concerned with Guerra International as a whole. This means that they will put pressure on the CFO to take actions that will positively affect the bottom line for Guerra. That's all from me. Thank you.